The default entity classification rule. So most of you are probably already aware of how this works with a U.S. company, right? I mean, if you set up an LLC, it defaults to a flow through. So multi-member is going to be a partnership. Single member is going to be a disregarded entity. The rule of thumb with foreign companies is that it's the opposite. If you have a foreign LLC, then it's going to default to a corporation, not a flow through. That's the rule of thumb. Obviously, there's a specific rule associated with that, so you can't always follow that. But basically, the actual rule is what I put here, and I've cited the reg site. But basically, it looks at limited liability. So, I mean, to put it simply, if the foreign corporation offers limited liability to its members or owners, then it's going to default as a foreign corporation. If it doesn't, then it defaults to a flow through. And so that's why I say the rule of thumb is if you have a foreign LLC, LLC by definition offers limited liability to its members. The foreign equivalent of that's going to give limited liability to the owners, and so it defaults as a corporation. A couple of things to think about there, and it's just differences with the U.S. system. For example, a lot of countries, or at least there are several countries that, in the U.S. we have the concept of a sole proprietorship. So you can just start a business. There's no legal entity associated with it, and it flows up to your personal tax return. And that's a sole proprietorship. There's no liability protection. In some foreign countries, they actually have legal entities for sole proprietorships. So just because, so if a client comes to you and they say they've set up, and I'm blanking on the name, there's one in Brazil in particular that, there's a legal entity type, and you look at it and you think, oh, that must be an LLC or a company equivalent. And if you use that rule of thumb I mentioned, where it's the opposite, you may treat it as a foreign corporation, but really it's just a legal entity that I'm not really sure what it's even for. If it provides no legal liability protection, I don't know why. I don't know what it's for exactly, but it would default to a flow through in that case because it's not offering liability protection. So at the end of the day, you really have to look at the rule itself. So this is an example of one. I mean, a lot of countries don't use the LLC wording. They use limited company. So Australia has the PTY limited company. The UK has a limited company. New Zealand limited company. Latin America has the limitadas that's similar. So these are all limited companies that provide legal liability protection. But again, I mean, if you no reason to just guess. I mean, I pulled this off of the Australian government website, the definition, just to show as an example, and it provides, that is their personal assets are not at risk in the event a company is bound up. So, I mean, it defines that the members have limited liability. So when you see that, you can say, okay, this is a foreign corporation by default. So if you don't know, I mean, generally, if you see limited, it probably is a limited liability company, but it's something you really want to look up each time because it's simple to do and just to be sure. So once you know what the default classification is, the next question is it an eligible entity? Meaning, can we change that default classification? And I should have put this last. Oh, I think I have a pen. I should have put this last part here, the per se entities at the top. But so the next part of this progression is basically you look at the foreign company and you look at its liability structure and let's say it has limited liability and it's a foreign corporation. So then if it's an eligible entity, we could make an election to treat it as a disregarded entity or a foreign partnership if it made sense to do so. Except you have to get over this hurdle of the per se entities. So just like in the US, we have the corporation, like an Inc., an incorporated company. You can't make a check the box election or an entity classification election on an Inc. It can only be a corporation. You can make an election to treat it as a S corp, but it can't be a partnership. It can't be a flow through. So what the IRS has done is they put together a specific list with this in this reg section that shows per country the legal entity type that is a per se company. So basically the equivalent of the Inc. in foreign countries. And with those companies, if you are one of those, or if if that company is one of those, you can't make an election, just like you can make an election with an Inc. It just is a foreign corporation. So I mean, I guess you could start there, or you could find your default status and then go there. But either way, you need to make sure it's not a per se entity. And just as a general rule, one difference that I see in foreign countries from the U.S. is that they, like in the US, our corporate entity, you can choose for it to be a publicly traded entity, or privately held. A lot of countries have a separate legal entity structure for publicly traded companies, and that's a lot of times what falls in this per se entity. Mexico is one that, and don't necessarily quote me on this, but I'm pretty sure in Mexico they have an SA. I'm not going to try to say the Spanish word for it, but the SA is a per se entity, and that's something I actually see pretty frequently. I mean, of all the countries, Mexico is probably the one where I see people fall into that per se, either intentionally or accidentally. I don't see it as much in other countries because the SA can be used from a private perspective very easy. They also have the SARL, I think, that's like the LLC. But anyway, the per se entity just means you can't make an election. But if you can, then the process is just like it is in the US with an LLC. So I guess the only difference is when you set up an LLC, you generally automatically have an EIN associated with it. That's just part of the setup in most cases. With the foreign company, you're obviously not going to have an EIN right off the bat, but you have to have one to file the 8832. So the first step is to complete the SS4, get the EIN, and then you can complete the 8832 to change the entity classification election. And I'm actually going to walk through the form quickly in the next couple slides. But before that, talk about the timing and the actual rules around this check the box election. The general rule is you can make an effective date of the entity classification election retroactive 75 days. So that means if you want to have a January 1 effective date, you need to file the 8832 by March 15th or so. That's the general rule. It's very rare that I actually get clients that know or have that foresight to make the election that quickly. And luckily, we have RevProc 2009-41, which gives us 3 years and 75 days if you meet the rules and have reasonable cause. Basically, what that means is that you have to, you can't have the return associated with the year you're looking for the election. So let's say you're trying to make an election for a company that was organized January 1, 2023. And now we're into 2024. If that return is delinquent, the 2023 tax return is delinquent, you can't make a check the box election on that. Or you can't go retroactively and use this RevProp to make a retroactive election. You also can't go backwards if you filed an inconsistent return. So let's say we went ahead and filed it with a 5471, and then we decided, no, it should probably be a disregarded entity. We'll get a better answer. You can't go back and amend that return to make the entity classification election. The rule is that the return associated with the election can't be delinquent, and you can't have filed a return inconsistent with the intended treatment. So you could go back, let's say you made the election or you didn't make the election and we filed it as a disregarded entity. We then could go back and change the status because within that 3 years and 75 days under the RevProc, because we filed it consistent with the intended treatment. So I guess the main point with that is that, because usually what happens is I'm gathering information for someone's tax returns and I find out that they have a foreign corporation. So at that point, it's a decision. You still have time at that point to make the entity classification election, I guess is my main point with this, because you haven't yet filed the tax return due date hasn't passed yet for that return, so you could still make the election under this Rev Proc. And the reasonable cause, in my experience, is very easy to meet. And then the last thing, that's just blanket 5-year rule. You can't just make check the box elections year after year. After you make one, it's a 5-year rule before you can make another one and change your mind. All right, so that's the election. And so this is, I hope this isn't too small, but basically this is the SS4. And I just wanted to go over just some little notes on this, the way I prepare it. But, you're going to put the foreign company name. I generally put the U.S. address on this, like of the U.S. shareholder, just because that's where they're going to mail the EIN. You don't have to use that address on the 5471 or whatever form you're filing for it. But unless you want to get the mail, the EIN number to the foreign location, I usually put the U.S. address. A big part here, I like so if what we're doing is we have a default foreign corporation, we're electing to treat it as a disregarded entity. I go in here and I put other and I say foreign corporation here, as opposed to marking corporation. Because if you just mark corporation here, the IRS is going to send you a letter or send the client a letter that says, hey, corporation, we're looking forward to receiving your 1120, April 15th or whatever. It's not, it doesn't mean you have to file it. And it doesn't, it's just that now you've put the IRS on notice that there's an 1120 that you're never going to file. So when you do it this way, it doesn't do that. But yeah, and so the only other point I'll make is that you can call this in, as opposed to, with the domestic EINs, you can do them online. You can't do that with a foreign corporation, but you can call the number. And it's a fairly painful process, but not that bad. But basically you can call the IRS. You have to fax this in, so that the client needs to sign it. You'll be the third party designee. You fax it in while you're on the phone with the IRS, and then they're going to talk through this entire thing. They're going to talk through this entire thing, and they'll say it letter by letter. That's why it's kind of annoying. So like if your company is like Foreign Company LLC, they'll say F, O. So they do each one individually. So, and then they give it to you over the phone. So then you get your EIN, put it in here, and then you can do your 8832, and you'll drop the EIN in here, and that's where then you can make this election. So, if it's an initial classification, I guess that's one thing I kind of jumped over. That timing I mentioned, like the 75 days or 3 years and 75 days, that's important. I guess that's important to get it to the initial classification. And that's where you really want to be, because if you try to make an election for an existing company, it's going to trigger a deemed liquidation of the company. And it's actually even more painful than that, in that it's no different than if you liquidate a US corporation. It's a deemed sale of the asset by the company, and then a liquidation to the shareholder. And that deemed sale of assets triggers subpart F and guilty, and it's kind of a mess. So a lot of times, if you miss these dates, it's really not worth the pain of trying to, make a check the box election, or at least change it to a flow through in midstream. So, anyway, so that's where you're either going to have an initial classification or a change in current classification. And you just have to look to see, is it going to create gain? If not, then it doesn't really matter. But the rest of this is fairly self-explanatory. Usually when I'm filing this, it's a foreign eligible entity with a single owner, or elected to be a disregarded entity, or multiple owners elected to be a partnership. It's pretty rare that I'm finding a foreign flow that defaults to a foreign flow through, and I'm electing to treat it as a corporation, like this. But you can do any of that. So, and then you fill out these parts, and director signs it. And at the end, this is where you have this late election relief. And the way I do it is basically I just quote the regs and just say, they have met each part of the regulation. Or it's not a reg, I'm sorry. It'd be the notice, the 2009-41 notice, the requirements related to that notice. Just list them out, and I may put something in there like the client was unaware of the default entity classification election and intended for this to be a disregarded entity. I personally never had a problem using the late election relief. I have lately had problems with the timing of it. I mean, I have some clients that I filed them in like February this year, and we still don't have the confirmation. But I guess that's another point that, like if a client comes to you, if right now you're working on client's return that you had extended, let's say it's an individual that owns a foreign corporation, and you want to make that entity classification election, and they started the company in 2023, you still can under that retroactive rule that I mentioned. You'll need to file this 8832 first, but once you file it, you can go ahead and complete the tax return because it will now be being filed consistent with the intended treatment, which you've filed an 8832 for now, even though you haven't gotten back the confirmation. I mean, yeah, if the IRS comes back and denies it, then you have a little bit of a problem on your hand, and that you're going to have to unwind it or figure out why they denied it. But that's pretty rare in my experience. All right, you got another poll that just popped up. All right, so I've talked a lot about this entity classification election, but I haven't really mentioned why it matters. So I left some notes here, just in the kind of like a pros and cons list. The main concept with corporation versus flow through. I mean, it's no different than in the U.S. in that it's, a concept of deferral. Or I guess in the U.S. it's not really deferral, but the general rule with a foreign corporation is that it earns income and you don't have to pay tax on it as a U.S. shareholder until you pull it out as a dividend. There are, there's anti-deferral rules that limit the ability to use that deferral provision. Just as an example, I mean, I have clients in the UK, for example, and they have their own strategy of like if they have a self-employed business, they set up the limited company and they have a certain amount they paid as a dividend, certain amount as a salary to take advantage of rates. It's a little different when it's a corporate structure with a corporation, a U.S. company that owns a foreign company, a UK company. But either way, one thing that gets around these anti-deferral rules is the high tax exception. So if they're paying right now, it's more than 18.9% foreign corporate tax on their income, then you get an exception from GILTI and Subpart F. So in those cases, it's not as necessary to make a flow-through election. But I have other clients like a real estate client example. If somebody have people that set up just like in the US, if you buy a rental property, you're going to want to put it in LLC. If you buy a rental property in Costa Rica, you're probably going to want to put it in Costa Rican equivalent of an LLC. In that case, if you're renting out the property and maybe you later want to sell it, I often opt for that to be a flow-through structure because one thing you run into is you have trouble carrying over losses in a CFC scenario. And also then you don't have to deal with Subpart F and GILTI. I mean, at the end of the day, you really can't generalize what's better, a flow through or a corporation. It's very specific on the facts. And honestly, this is where you can add a lot of value to clients because you have to take into not only their current situation, but what are they planning on doing later? If somebody has a rental property and they're planning on just moving to the foreign country and moving there, there's so many examples to think through. But, in that case, flow through doesn't make sense. But if they're planning to sell it, it might. I don't know. So, I mean, this to me, this has been a big part, of where my advisory comes in. Really, is deciding for clients, helping them decide what's a better structure, a flow through or corporate. So, definitely something to think through, and it'll be very fact specific. All right, so I'm doing pretty good here. 2227. So now we're going to look specifically at the Form 5471. So again, just kind of back to this whole idea of the progression. We have to know what we're dealing with before we even get to the 5471. We got to know, is it a foreign corporation from a U.S. tax perspective? And if it is, do we want it to be a foreign corporation? If not, we can make an election, treat it as a flow through. But if it is, now we're in 5471 land. And so the next step with 5471 itself is who has to file it and what's the implication of that. So we're going to be looking today, we're going to be looking just at this first page, in the top of the first page. So we're going to look at mainly these categories of filers, because I guess that determines the type of filer and the implication of the type of filer. I'm going to look at some of these check boxes, like this box E has to do with the 8938. We'll look at filing on behalf of foreign corporations. And then we'll talk a little bit about tax years. That's if we get there. That's the last thing. All right, so that's the plan with the 5471. All right, so what is the Form 5471? So basically, this is required to be filed by U.S. shareholders in a foreign corporation, depending on their ownership. And really, to put it kind of simply, the only reason the Form 5471 exists is because of the anti-deferral rules. So because of GILTI, subpart F, section 956, which is kind of similar. So all of these rules that require a U.S. shareholder to pick up the income of the foreign corporation before it's actually distributed to them. That's the only reason the 5471 exists, because otherwise you would just treat it like stock ownership in any other company. If you own stock in Apple Inc., you pick up income when you sell it or if you get a dividend. So the only reason this form exists is to kind of for the IRS to know. I guess some of it's just like they want to know who owns foreign corporations. So it's some of it's just informational. And then the other part of it is, are people paying tax when they're supposed to based on these anti-deferral rules? So in the form itself, it's filed with the U.S. shareholders tax return. So if it's an individual, it's included with the 1040. Partnership, it's included with the 1065. You don't file the 5471 by itself. You don't need to extend it separately. It's extended automatically with the extension of the filer. So it's basically a mini corporate tax return within the U.S. person's tax return. And then the filing requirements are broken down by categories, like I mentioned. All right, so here are the important definitions, because I'm going to be saying these words a lot: U.S. shareholder, U.S. person. So it's important we understand what they mean. U.S. person is this one is probably the most intuitive of all of them, but it's any U.S. Tax return filer, really. So I mean, U.S. individual, and that could be citizen, green card holder, somebody that meets the residency rules. If they're filing a 1040, basically. Domestic partnership, domestic corporation, domestic estate or trust. I don't deal a lot with nonprofits, but they also can have 5471 requirements. So really any U.S. tax filer. The main confusing, or at least this one you kind of just have to memorize, is the definition of U.S. shareholder. So for purposes of the 5471 and subpart F rules, a U.S. shareholder is a U.S. person, as defined here, that owns more than 10% or 10% or more of the total combined voting power or value in the shares. So I guess I'm going to read the definition of controlled foreign corporation so you can see how that's layered in. But a CFC, a controlled foreign corporation, is a foreign corporation in which, on any day of its tax year, more than 50% of its voter value is owned by U.S. shareholders. So this is the same definition as up here for U.S. shareholders. So as a simple example, if you have 11 U.S. individuals that own equal shares in a foreign corporation, there's no way it can be a controlled foreign corporation. Even though it's controlled 100% by U.S. people, it's not controlled by U.S. shareholders because none of them would have more than 10% or 10% or more. And I think my math's right there, but I think you know what I'm saying. If they don't count as a U.S. shareholder if they own less than 10%. And we're going to talk about attribution rules because that's where it can get a little tricky. If you're related, if they're related people, then you can start attributing ownership from one person to the other. But it's general rule: U.S. shareholder has to have at least 10%. So yeah, and I'll point out here, I left a little caveat for captive foreign insurance companies. Captives kind of operate in their own little world, and I'm not getting into that in this presentation, but just recognize that what I just said does not apply for captive foreign insurance companies. The rule, there's no 10% rule for shareholders, and I think the 50% drops to 25% for foreign captives. So if you're dealing with an insurance company, just be aware that they operate in their own world with different rules. Yeah, pretty much. Okay, so then indirect and constructive ownership. Indirect ownership is what it sounds like. I mean, if you have U.S. person, a U.S. company that owns a foreign corporation, that foreign corporation owns another foreign corporation, that bottom tier company is still a CFC because the U.S. person indirectly owns it through the upper tier foreign corporation. So basically, you're looking at indirect ownership through multiple companies. And then constructive ownership is a little bit more tricky, where somebody can be deemed to own shares that they don't actually own. And we'll talk a little bit more about that when we get into the specific categories. And I put together this slide here. I'm not going to go into too much detail. I just think it's kind of a cool slide showing the implications of being a controlled foreign corporation. So all of this, like subpart F, GILTI, transition tax, that's your anti-deferral rules. And this is meant to show the flow of money back up. So I mean, if you have an exception from subpart F or GILTI, then the money comes up and it's a taxable dividend. If you're subject to one of these rules, it gets taxed immediately, and then the distribution comes out as previously taxed income, and it's not taxed. But this is kind of more for getting more into the weeds of the taxation of controlled foreign corporations, but rather than the ownership. But just wanted to throw that in there. I'm not going to spend a lot of time on it. All right, so then I pulled this directly from, you got another poll that came up. So I pulled this directly from the instructions, and I have to look at this very frequently. And that's one thing I'll point out is there's no way you're going to memorize all this information. I do this a lot, and I have to go back to these rules very frequently because I don't memorize it. It's just more knowing what questions to ask and where to find the information. So like we're going to be talking about the different categories of filers, and this chart in the instruction tells you, all right, if you are a category 3 filer, these are the schedules you have to include. So you're probably not going to memorize that, but it's a very simple chart to find and look up. You just have to know what category filer you are. So just a quick note on the categories. There's a bunch of them here. I think it's 9, right? 3. Not too long ago, there used to be 4. So pre-Tax Cuts and Jobs Act, for a long time, there were just 4 categories. Category 1 was repealed. We had 2, 3, 4, and 5. With the Tax Cuts and Jobs Act, that triggered transition tax. And I'm not going to go into a lot of that or I'll run out of time, but um, basically they created a new category for transition tax. The whole point of it was at December 31, 2017, if you had a foreign corporation, if it was a controlled foreign corporation, you had to pick up the income, the accumulated earnings of that company today and pay tax on them. That's the basic idea. So they created a new category for that, category one, to show that you were subject to these transition tax rules. And then as part of the Tax Cuts and Jobs Act, they repealed one of the provisions, 958B4, that used to block what's called downward attribution. I'm not going to get into that, but that's what 1B, 1C, 5B, 5C. So basically the idea is now, if you have if you have a foreign company at the top and you have brother, sister, and it owns brother, sister, foreign company and US company, you can potentially the downward attribution rules can make the US company a owner of its brother, sister foreign company through attribution of the parent. So that's what downward attribution is. And there's more, complicated examples of that, but 1B, 1C, 5B, and 5C, those are meant to deal with that, and kind of some leniency around that because, you can imagine it'd be hard to get the information from a foreign company that the IRS says you own, but in reality, you don't own that company, so they might not want to give you their information. But we're not going to talk about those, but those are specific to downward attribution rules. So we're going to be talking about 1, 2, 3, 4, and 5 categories. And category one, like I said, this one is specific to transition tax. And basically, the requirement for it is, if you have a Section 965, Section 965 is the transition tax code section. Specified foreign corporation is defined as a controlled foreign corporation. The main thing I wanted to point out with this was that, back in 2017, we're filing 5471s with transition tax. I think that category started in 2018, but so we would check this box as category one filer, and I just continued doing it because it's very clear. If it's a controlled foreign corporation, it's a specified foreign corporation, you have to file it. But somewhere along the line, and I can't remember now, but in 2020 or 21 maybe, they added this exception to the instructions. And I lifted this. This is a copy and paste directly from the instructions. But it basically says if you don't have if you're not paying transition tax in the current year, either because you're subject to it today or there's a deferral that you're still picking up for that year, for this year, then you shouldn't be checking category one. So just because you're a controlled foreign corporation, unless you're actually picking up transition tax in that year, you don't file category one. And so for a while, that kind of confused me just because, I guess it's pretty clear, but then the requirement's pretty clear that CFC has to file it. I don't know. I just kept checking the box because I figured, over reporting, what's the big deal? And then I got a client that got a notice that basically said this was like in 2022. I filed a 5471 for somebody, check category one. It was a small company. Certainly there was nothing that had to do with transition tax on their 2022 5471. And they get this notice, and it's not really telling them they owe transition tax, but what it's saying is we noticed that you checked the category one box, and here's some information on paying your 965 transition tax. You may potentially be subject to it. So it kind of proved to me that box does mean something. It's triggering something on the IRS side to make them think that, you may owe transition tax. So I don't check that box anymore. I think the exception is pretty clear and the instructions. So, unless at this point, really, unless you had an S corp that you deferred the transition tax, you could defer it like 8 years and you're still picking it up. I'm not checking that 965 box for anybody. So that's category one. All right, now we're going to talk about categories 2 and 3. They kind of go together. And these two categories of filers are these are the transactional categories. So you can be a category 2 and category 3 filer just based on acquisition or disposition of shares, regardless of control, whether it's control of foreign corporation or anything like that. So category 2 Category 2 is for officers and directors, and it's specifically for an officer or director of a foreign corporation where a U.S. person has crossed the 10% threshold. So that's a very common thing to just keep in your head, this 10% threshold. So I mean, the simple example, if you set up your own foreign corporation, you're the director, gone from 0 to 100, and now you've crossed that 10% threshold. So you're going to be a category 2, and we'll talk about a category 3 filer as well. You can have weird situations where a director could have a category 2 filing requirement regardless of whether it actually owns an interest in the company. Like if I set up a company and I named my an attorney as the director of the company, and I've crossed the 10% threshold, the director is now a category 2 filer. You don't see that much because of this exception, which says, if you have 3 or fewer that own more than 95%, that doesn't come into play. But you could see it where, if there were 5 shareholders and we named our attorney as the director, they technically have a category 2 filing requirement. I'd argue that that's probably one of the most abused and not necessarily ever complied with parts of the 5471, because first of all, the filer probably doesn't know, and how would the IRS ever know? But anyway, technically, there's that possibility. So category 3 is similar to category 2, where it has the same 10% threshold, but it's for the owner. It's not for the director, unless they're the same person. So if you acquire or dispose of an interest in a foreign company that pushes you over that 10% threshold or drops you underneath it, then you're a category 3 filer. And that's the main difference too, to point out, is that with category 2, it's only on acquisitions. So, if the year you set up a company, if you're the director, you're going to be a category 2 and 3 filer. If you liquidate that company as the sole owner, you're only going to be a category 3 filer, because the category 2 is just on the acquisition side. And the other thing to point out with this one is it also applies to, like a foreign person that moves to the U.S. and becomes a U.S. resident. They may have owned a foreign corporation, that they may have been the 100% owner the whole time, but then they move to the U.S. and all of a sudden they're a U.S. shareholder. Now they've crossed that 10% threshold as a U.S. shareholder, and so you have this filing requirement. And I'm going to talk about these exceptions. I'm skipping over it because they have to do with attribution rules. So those are the basic rules of when you have to file category 2 and category 3. But it's pretty simple if you're talking about one owner. If it's a company or a person, it's pretty straightforward. But when you're talking about individuals, it can be confusing because of these attribution rules, where you are considered for category 2 and 3 purposes to own the stock of spouse, siblings, ancestors, lineal descendants. So even if you personally don't cross that 10% threshold, you might when you combine it with a relative. So as a quick example, I have a client from Germany. Family owns a fabrication company. Dad owns like 60% of it, and then the siblings all own 9%. One of the kids moved to the U.S. to start up a U.S. operation for the company, became a U.S. resident. So he only owns 9%. So like I said in the last section, you become a U.S. shareholder, that can trigger category 3, but only if you cross that 10% threshold. Well, because of attribution, he owns the stock of his siblings. So you have to add in his sibling shares, and that gets him over the 10%. So he had to file for category 3 for that reason. But if you don't have any direct interest, the exception here is if you don't have any direct interest in the company, then there's no constructive ownership. So, if his dad owned 100% of this company and he moved to the US, I'm sorry, let's say his brothers and sisters owned 100% of the company, he owned nothing and he moved to the US, there's no attribution. I mean, there is attribution from siblings, but you're accepted from having to file because of it because you don't have any direct interest, which makes sense because you don't own anything. All right, so here's some common category 2 and 3 scenarios, but I really just talked about each of those, so you can look at those later. But when you have category 2 and 3, one of the schedules you have to file, excuse me, is the Schedule O. So this part 1 is for category 2 people, so officers and director. You include the U.S. officer and director here. You're going to include the U.S. shareholder here. If it's a purchase of a company, you put in this section, I can't even read it, section C, I think, for acquisition of stock. But if say you set up the company, or if it's part of like something more complicated, like a reorg, then it goes in this bottom section. And here's where the disposition would come if you got rid of it. But just remember, category 2 and 3 always comes with the Schedule O. You're never going to have one without the other. All right, so the last two that I'm going to go through here, and I hope I can leave a little time for some questions, but category 4 and 5. So category 4 is control. So this is where category 4 filer is a U.S. person who had control of a foreign corporation at any time during the year. So control is more than 50% voter value. And that can happen through attribution as well. So there used to be a 30-day rule, but now any day. So basically, if you buy and sell, if you buy 90% of a company one day and then a week later you sell that 90%, you're still a category 4 filer because for those 7 days you had control of the foreign corporation. I'll talk about attribution. So the one thing to point out is the attribution rules are different, which makes it more confusing, but they're different per category. So one thing that's different for category 4 is there's no sibling attribution. So my client from Germany, he had to file the first year for category 3, but then the second year, he's not attributed the shares of his siblings. He's technically attributed the share of his parent. I can't remember how that worked, but he's not attributed the shares of his siblings like he was for category 2 and 3 purposes. And the other important part is non-resident alien attribution. So one of the strategies that I use a lot, at least for expats who might be married to non-residents, and I'll talk about this in category 5 more, but is to split the ownership between them and their non-resident spouse. But you still have to attribute for this control purpose. You have to attribute that ownership to the U.S. person. And again, we'll see. So I guess let me do category 5 real quick, and then I'll try and summarize this a little better so it's straightforward. I feel this can get in the weeds real quick, but like I said, there are a lot of common scenarios. So I mean, you can certainly get in these complicated scenarios, but most of the time, this is what you're dealing with. But I'll talk about the scenarios more in a second. So category 5 filer, this is your controlled foreign corporation. This is where you have U.S. shareholder or U.S. shareholders that collectively own more than 50% of the company. So the difference with the attribution rules with this one is that there is no family attribution from a non-resident alien. So what I talked about before, the strategy that I do with expats is you can have you give 50% of the ownership of the foreign corporation to a non-resident spouse. So now it's 50-50. And it's not a controlled foreign corporation anymore because you don't attribute the ownership of the foreign non-resident spouse for category 5 purposes. Category 5 is the only one that matters when you're talking about guilty in subpart F. Category 4, we still have to attribute the ownership for category 4 purposes. And so he's considered to control the corporation, but it's not a controlled foreign corporation. I know that's super confusing, but so he still has to file 5471, but it's not category 5, so there's no guilty, no subpart. All right, so I have some examples here just to kind of talk through how these work. But basically, this is showing you got 3 U.S. shareholders. 15 plus 32, so 47% ownership plus this 5%, that gives you 52%, right? But this US citizen is not greater than 10%. So you don't count him. So here we only have 40% ownership, so it's not a controlled foreign corporation. That's like a visual example of how that 10% rule works. This is kind of the opposite of that, where if you have the US citizen, in this case, owns the US corporation, there's attribution of these shares. So now you do take into account that 5%. All right. And this is what I was talking about with the NRA spouse or parent or sibling. You can look through these, but basically, here there's no attribution because there's no direct ownership. Here you have attribution from the parent for category 4, but not category 5. Same thing here. Category, I'm sorry, same, wait. Okay, sibling, right, because sibling, category 4, you don't attribute from a sibling, don't attribute. So those are some quick examples. So I'm going to go through, I guess there's really only a couple more slides, and I'll leave some time. But the last main thing is and here's the last poll, I think, that just came up. But one of the exceptions I've left out, which is the most important exception, is this filing on behalf of concept. So the basic idea is if you have two people that have the same filing requirement, you can, one person, or I mean, this could be, when I say people, it could be companies. One person can file on behalf of the other person, so they don't have to both file. The common example I have for that is, U.S. person, individual owns an S corp or a partnership that owns a foreign corporation. I've seen this, and I do it both ways. You can have the U.S. individual file. Oh shoot, sorry. You can have the U.S. individual file 5471, and file on behalf of the S corp, so you don't have to both file. Or you can do it the other way, and the S corp file the 5471 on behalf of the U.S. individual, so they don't have to file it. I think you can do it either way. I mean, a lot of times I see people do it where the U.S. individual files, and I think that's usually just because it gives you another month before a deadline. I tend to like doing it at the S corp level because I think there is some. I worry a little bit about requirements on the Schedule K2 and K3, like making sure you're doing that right. But actually, I don't know that that's really. I don't know that that's something I should worry about. I think you're okay to do it either way. And so I've shown it here, so you have to mark here that it's being filed on behalf of on line H. And then that person has to put on their return that their 5471 requirements being satisfied by the individual. And this is just the opposite of that. S corp files on behalf of the individuals. I'm going to leave some time here to talk. So these slides really are pretty self-explanatory, and with 8938, and the tax year is basically just to say you have to follow the tax year of the majority U.S. shareholder. And a quick teaser. So the next part of the series is going through the actual examples and preparing these specific situations, which I said are the common scenarios I see. Yeah, so y'all can type in any questions here if you have any, shoot them out. One thing on the 8938 part, just because I see this missed a lot, or at least this concept misunderstood. But basically, you can check this box E, or I can't even read it. I think it's box E, where it's an accepted specified foreign financial asset. And the 8938, you have to file that when you have foreign financial assets that exceed a certain threshold. That threshold depends on whether the U.S. filer, and this is specific to individuals. So there's some narrow exceptions where like an S corp could file it, but this is specific to an individual shareholder. But the 8938 has certain thresholds, and so a foreign financial asset includes stock in a foreign corporation. So you have to include the value of the foreign corporation in determining whether you've crossed the threshold to have to file the 8938. But if you file a 5471, you don't have to actually put the information in the 8938. You just have to use the value to see if you have to file it. So you can have a scenario where if your only foreign financial asset is that foreign corporation, then and the value exceeds the threshold, then you just kind of have a blank 8938 and you check this one box here that shows the number of 5471s. So I guess the point is the 5471 satisfies the requirement of including that financial asset in the 8938, but it doesn't mean you don't have to file it.